Close your eyes and go back to the early 1980s, to the chaotic, noisy, and high-energy trading rooms of Chicago of that era. To those moments when one of the most legendary bets in the financial world sprouted. In the lead roles of this story are the legendary figure known as the commodities king of the markets, Richard Dennis, and his mathematical genius partner, William Eckhart. Today, we're going to talk about perhaps one of the most discussed and most inspiring events in financial history, the Turtle Traders experiment and the unshakable mechanical system behind this experiment. Everything started with a very fundamental difference of opinion between the two partners. Richard Dennis argued that being a good trader was not an innate talent, but a skill that could be acquired entirely through systematic training and unshakable discipline. According to him, markets were a game of mathematics and psychology, and anyone who learned the rules could win this game. His partner, William Eckhart, vehemently opposed this idea. According to Eckhart, trading success required a genetic predisposition, an instinctual talent, and high mathematical intelligence. It could not be learned later. It had to be inside a person. This deep and passionate divergence of opinion eventually gave birth to that famous experiment. One day, Richard Dennis visited a turtle farm in Singapore. He was so impressed by the systematic production process there, by the fact that everything was tied to a certain rule and order, that when he returned to Chicago, he said that historic sentence to his partner, "We can raise successful traders just like they raise turtles in Singapore." He had made his point. They took the bet one step further and placed ads in the major newspapers of the time. Thousands of applications poured in. From among these applications, Dennis and Eckhart selected a group of completely ordinary young people who had absolutely nothing to do with finance and invited them to Chicago. Among them were factory workers, security guards, and board game designers. The very system taught to these ordinary young people, which literally turned them into millionaires in just a few years, is a massive trend-following system based entirely on the pure power of mechanical and technical analysis, known today as turtle trading. So what lies at the heart of this system? Let's take a closer look at Richard Dennis's revolutionary and equally simple approach to technical analysis. For Dennis, technical analysis was never an attempt to gaze into a crystal ball and predict the future. He never fell into that big mistake many amateur investors make today, namely, the illusion of knowing in advance where the price will go. On the contrary, he saw charts as a transparent reflection of collective human psychology and the supply-demand balance in the market. The most powerful sentence that summarizes Dennis's philosophy is this: technical analysis is not a forecasting tool, it is a reaction tool. The market never tells you what it should do. It only tells you what it is doing right now. Your job is not to show resistance against the price, to impose your own truths on the market, or to harbor a prejudice, but to attach yourself to the current movement in the most efficient and smoothest way possible. At this point, when we deeply examine the technical mechanisms of the turtle trading system, we encounter two main strategies with very clear boundaries. The first system, the short-term system, is built on a 20-day price breakout. The rule is simple. If the price breaks the highest level of the last 20 trading days upwards, this is a buy signal. If it breaks the lowest level downwards, this is a clear sell signal. However, Dennis added a very critical filter into this simple rule. If the previous 20-day signal resulted in a successful trade, meaning a profit, the system considers the next signal risky and skips it. It just watches. Why? Because this is an ingenious filter designed to prevent the market from setting traps in overbought or oversold zones. The second system is the more conservative and longer-term 55-day breakout system. Here things get a little different because no filter is applied. The moment a new 55-day high or low is seen, you enter the position without blinking an eye, regardless of the outcome of the previous trade. In Dennis's philosophy, the purpose of these two separate systems is absolutely not to miss those massive macro trends that might form in the market. This approach, also known in technical analysis as Donchian channels, considers the price exceeding its own past, that is, those historical levels, as the greatest show of strength. But wait, the true genius of the system is not just hidden in when you will enter the game. Perhaps much more importantly, it is how much capital you will enter the game with. Right at this point, the concept of N in the literature, which is what we know today as the average true range, or ATR for short, comes into play. This structure, a contribution of William Eckhart's mathematical genius, places volatility, that is, the fluctuation in the market, right at the center of technical analysis. For Richard Dennis, rather than the current price of a stock, cryptocurrency, or commodity, how volatile that asset is and how aggressively it moves is what matters. The N value takes the volatility average of the last 20 days and tells us the market's breathing room in the literal sense of the word. A turtle trader calculates the size of every position they will open based on this N value. Think of it like this. In a market where volatility is very high and prices are swinging, smaller positions are opened. In a calm market where volatility is low, larger positions are taken. This way, no matter how severe the storm outside is, the risk you take always remains mathematically constant. You don't lose sleep. Another wonderful technique applied after entering a position is the pyramiding technique. This technique is the greatest proof of how aggressive, yet at the same time, how controlled Richard Dennis's understanding of technical analysis was. Dennis used to say, if you are right, you should be more right. What does this mean? After a position is opened, if the price advances by every 0.5 N in the direction you expect, meaning a certain profit relative to volatility begins to enter your pocket, a new unit is added to the current position. An addition is made to the winning trade. These additions can go up to a total of 4 units. This strategy allows you to use your capital with maximum efficiency only and only when the trend is truly strong, when you have the wind completely at your back. However, while reaching this massive size, risk management is never, ever abandoned. In the turtle system, the risk taken for each trade can absolutely never exceed 2% of the total capital. The stop-loss point is placed exactly 2N below the entry price. If the price moves opposite to your expectation and causes a loss equal to twice the volatility, your analysis is considered flawed. At that point, you don't hope, you don't pray, you exit the position completely emotionlessly, like a robot. If the position has been gradually enlarged using the pyramid method, the stop level of all units is pulled up step by step as new additions are made. Thus, even if you haven't put the profit in your pocket yet, the amount you would lose in a potential sudden reversal is already minimized. Perhaps the most difficult part of the job, the part that requires a psychology like steel the most, is the exit strategy from the position. This is the step of turtle trading that requires the most discipline. Many amateur traders get excited the moment they see the profit on the screen. Their hearts start to beat fast, and they immediately press the sell button out of the fear of what if this profit reverses. Because Richard Dennis knew this weakness of human nature very well, he set very clear rules to eliminate it. If you are in a long position in the first system, you continue to sit on that profit until the price drops to the lowest level of the last 10 days. Yes, sometimes your open profit melts away, but you continue to sit. In the second system, this waiting period is 20 days. This rule sometimes means giving back 20% of a massive 50% profit to the market. Most people cannot handle this psychologically. However, according to Dennis, big money is made by staying in the trend until its very last drop. In technical analysis, this approach is the most primitive, but believe me, the most effective form of the trailing stop logic. When the exit point is reached, you don't wait for the stop to blow, that is, for the price to break through it. The trade is closed in the exact second, even if the price just touches that level. This strict discipline completely disables the trader's personal views about the market, their hopes at that moment, their fears, and their egos. In Dennis's approach to technical analysis, there are no complex formations, eye-straining indicators, or complex oscillators filling the screen. He always used to say this: complex analysis doesn't make a trader smart, it just makes them indecisive. In his world, where an indicator is, or whether a head and shoulders formation has formed on the chart, are completely secondary issues. What matters is always the price. The price breaking that 20 or 55-day high we talked about represents the clear consensus of thousands of participants in the market at that moment. Dennis saw technical analysis as a game of statistics. He knew very well that getting stopped out a lot, making consecutive small losses, and losing money in a sideways market for a long time were a perfectly natural part of this game. However, he had proven this mathematically. When he caught a trend, that single trend would bring back all those small losses in the past manifold. That is why technical analysis was never a guessing game for him, but perfect expectation management. There is a point we particularly need to underline. Dennis's biggest difference from everyone else in the market was using volatility, that is, the fluctuation of price movements, as a risk measure. While most people see support and resistance levels as random horizontal lines drawn on a chart, Dennis would stretch these levels according to the market's volatility. Instead of wasting time trying to understand whether a breakout was real or fake, he would calculate with how much risk he would participate in that breakout. This vision took technical analysis out of that static, stationary picture and turned it into a living, dynamic process. According to Dennis, finding perfect entry signals is only 10% of the job. True success, the place where the real money is made, is in the remaining 90%. That is, in your position sizing, your risk management, and that iron discipline you show when exiting a position. The reason why one of two traders, standing in front of the same chart, having received the same training, becomes a millionaire while the other goes bankrupt is not the magic indicators they use. The reason is their loyalty to this mathematical architecture we talked about. The truth that emerged as a result of this unforgettable experiment by Richard Dennis and William Eckhart was clear as day. Trading is indeed a teachable art, but only for those who follow the rules to the letter. Those among the turtles who made millions of dollars and became legends were the ones who accepted Dennis's rules as a dogma, as unshakable laws. Those who failed and were eliminated were the ones who tried to add their own genius to the system, bending the rules by saying the market has risen too much, it will turn from here now. Dennis's technique completely crushes and excludes the ego. It says you cannot be smarter than the market, you can only follow the market. Structures like cup and handle or Elliott waves might help you in determining direction, but they can never impose a target price on the market. The past can show the direction, but can never limit the distance, says Dennis. No one can know how far a trend will go, and trying to know is a completely futile effort. Trend following is the purest, most honest, and equally ruthless form of technical analysis. It allows you to obtain very high total profits despite having a very low success rate, that is, a low winning percentage. The turtle system teaches us that trading is actually a test of character. When the price breaks the high, everything looks very easy and fun. However, the real test is being able to stay inside that position for months, watching a part of the profit melt away before your eyes, and being able to stay loyal to your stop level to the death. This requires massive psychological strength. Dennis made his system so clear and mechanical that he completely eliminated that heavy stress in the trader's decision-making process, that burden on their shoulders. In conclusion, Richard Dennis's success did not come from drawing the right lines on the chart. His success came from finding a mathematical order within that crazy randomness of the market and applying this order without breaking it under any circumstances. He took trading out of being a guessing game and transformed it into a discipline of probability and risk management. The saying, "Follow what the price is doing, never think about what it should do," is actually the summary of his entire life. Today, even at the foundation of many complex strategies used by massive funds, supercomputers, algorithms, and artificial intelligence in modern markets, lies this trend-following logic that Dennis built in those years, with simple but unshakable rules. The Turtles experiment proved not only that ordinary people can also be traders, but also what a great weapon a disciplined mind and the right philosophy turn into in the financial world. This system continues to remind us every day that the way to survive and build wealth in the markets is not in complex formulas, but in the unshakable loyalty shown to simple rules. Remember, technical analysis is not just reading charts. It is the ability to understand the soul of the market and to be able to move in harmony with that soul, without ego. Dennis's path is the path of patience, mathematics, and absolute discipline. Markets may change, technologies may change, the products we buy and sell may change. However, human psychology, the reactions people give to price with fear and greed, have never changed from Richard Dennis's era to today, and probably never will. That is exactly why turtle trading principles will continue to illuminate our path as timeless classics on the brightest pages of financial history.